if you're watching TV, you've got to be just as disgusted as I am because you know what? They're just playing head
It's
games.
you and me, baby. Head games. And I can't take it anymore. Head games.
Hey guys, it's your favorite mortgage guy, Steve here. Listen, another edition of our segment, head games. Just like the song said. You know what? Are you playing head games? It's like clickbait. You know what? It's if you're watching TV, it's madness. So let me start with your questions here. What are rates doing? Okay, I'm going to talk about that further down in the segment. Does it benefit me to pay points? Yes, in many cases for a couple reasons. One, in a decline in interest rate environment, probably not. Unless you're looking at maybe refinancing and you're thinking, okay, I'm buying this house. If I pay a couple of points now, is the cost of the points cheaper than the refinance cost? That may be the better deal for you right there. Now, takes a conversation with me because you can't do this math on your own. You need the software to process this data. Here's a great one. I must have gotten 50 responses on this one. Should I give up my low interest rate? Here's why. Nobody cares. Nobody cares that you got a 2, a 3, a 4, or 5. You've been bragging all along that you've got this rate, but in the same token, you've got a bunch of equity, a couple $100,000 worth in many cases. But you may have gone out and bought a new car, a boat. You did some renovations. And you said you were going to put it on your credit card, but you're going to pay it off. You and I both know you're not paying off $40,000 on that credit card. You're going to make the minimum payments or maybe a couple hundred extra dollars more at 30% interest. So here's the thing. Why should you should give up your low interest rate? Because if you're in debt and you can save cash flow for a little bit more in interest, who cares? You're the one that's paying those bills, not me. Meanwhile, and I'm not being negative here, guys. I'm really am not. I'm just telling you the hard cold facts. You're looking at your credit score on your bank statement, your credit card statement, whatever. That score is going to continue to drop, especially if you're bumping up against the high credit limit or if you exceeded the high credit limit. Guys, I see this every day on the phone calls I take with people who are looking to refinance and they've exceeded their credit card limit and their credit scores are in the sixes when they used to be in the high sevens. So, guys, listen, I'm just telling you, there's why you should not worry about that interest rate. All right, let's jump in because I feel like I say every week, but it clearly needs repeating. Stop reading just the headline. Guys, you've just got to read the story. Headlines are designed to grab your attention and not give you clarity. And you know what? The perfect example right now is all the noise surrounding the president and the Federal Reserve. Everyone's acting like some unprecedented crisis is happening. It's not. Almost every forward thinking president in modern history has clashed with their Fed chair during their administration. And do you know why? Because they want the same things you want. They want affordability, they want stability, they want a strong economy, and they want what's best for the country long term. Everything else you're hearing, it's a distraction, it's noise, it's clickbait. So instead of reacting to the headline, let's just talk about the actual data. Now, the same information I've been sharing with you consistently over the past 45 days. Let's start with home prices. The median home nationally right now, you know what it is? Well, I'm going to tell you, it's $405,000. That's the average across the nation. And a quick reminder, median means middle. It's the true average of the market. Now, that number is up 5.15% over the past 3 years. Remember what I just said about refinancing? If you bought a house 4 years ago for $500,000 and your house is up 5% in value, that's pretty strong. So, despite all the fear, all the talk, the crashes, the bubble prices have continued to move higher at a very healthy pace. Now, the key part about that is this, it really just leads up to the next and most arguably point that the part of the puzzle, and I'm kind of thinking because I got so many thoughts going in my head about this inventory. Okay, that's the real story. Across the nation, there are 1.18 million homes for sale. 1.18 million homes. There's 330 million population. There's only 1.18 million homes. It sounds like a big number until you put it into context. That equates to a 3.3 month supply of homes. In a normal market, a balanced housing market, we should expect closer to 4.6 months inventory. We are nowhere near that. That's the supply and demand piece I keep telling you guys. Buy the house, not the rate. You know what? It's certainly cheaper to buy a little bit of carpet to replace the ugly carpet, a little bit of paint, whatever you need to do, versus putting the house around the brand new couch you just bought. And that's why it's an annoying point, because I'm just going to keep on annoying you. Buy the house, not the rate. Here's the cost of waiting. Let's do the math. So let's talk real numbers, okay? Not just theory, right? You can pull out a piece of paper. You have a $400,000 loan. A half point difference in rate makes about $100 a month, right? How much is that per year? You're right, $1,200. Let's say instead of waiting, you bought the home. Now that home increased just 2%. Let's do the math a little differently. Let's say it's on a $300,000 home. 2% times 300,000 is $6,000 in equity. So you're telling me you'd rather save $1,200 a year by waiting, hoping the house doesn't go up in value, waiting for rates to come down, and miss out on $6,000 equity? I don't know about you, but I'll take that all day long. And that's the math people don't want to talk about in the headlines. I don't get it. So, why supply isn't catching up? Another major factor is this: builders, they simply can't keep up with demand. Now, labor shortages, material costs, permitting delays, zoning issues. What happens next? Well, here's what you're going to see: you're going to see new construction pick up, the sales. You're going to see higher price sales, because it's going to rise, because building costs are going to continue to go up. You're going to see firmer delivery timelines, and you're going to see less flexibility from builders, because you know why? People are out banging on builders' doors right now. And believe it or not, that's actually good news for the housing market. Now, here's the thing: people say, well, why is it good news? Because it creates stability, supports values, reinforces the fact that housing is not overbuilt. So, here's some other big news. I'm flipping the gears here. Big news on FHA. Now, let's talk about something important, like especially for first time homebuyers or any FHA buyer, because the National Association of Mortgage Brokers is urging FHA to eliminate the lifelong mortgage insurance rule. Now, right now, the only way to remove mortgage insurance on an FHA loan is to refinance out of it or just sell the house. Compare that to conventional loans, where PMI automatically drops at 78% loan to value. Guess what? NAM is asking FHA to adopt a similar approach. Now, they're not the first ones, but maybe with this administration, maybe they'll get some teeth. If that happens, it would be a huge win for homeowners and affordability. This kind of policy change that actually matters, not the political noise you're seeing in the trending headline. Guys, here's what I'm going to say. This week was brutal because the president and the Federal Reserve were fighting. It's just noise. Ignore the noise, but read the story, or just rely on me to give you the information. So, what are rates really doing? Here's the honest answer: rates are volatile right now, not broken. Okay. They're reacting to inflation data, treasury movements, global uncertainty, and yes, sometimes political headlines. But markets don't move on emotion long term, they move on economic fundamentals. Now, demand still outpaces supply. Homeownership remains a hedge against inflation, and equity continues to build for buyers who act. So, what I want you to know is this: I've lived through multiple administrations, rate cycles much higher than today, recessions, booms, busts, and one thing that's always held true: what do I keep telling you? Equity prevails. So, where are rates right now? Yes, they are on a slow incremental decline. It's very volatile right now. It could go down one day, but up the next. So, is it predictable? Absolutely not. Are people out buying houses? Absolutely yes. My phone is ringing off the hook. You've probably heard the text go off 12 times. It's realtors looking for pre-approval letters. So here's my message for the week, okay? Stop letting the headlines scare you out of good decisions. Stay focused on facts, math, and what your long-term strategy is. It's not about timing the rate. It's about timing the market you're living in right now. If you want to talk through it, you need to call me. Your personal situation, your number of options, whatever the strategy is, budgeting, whatever you need. Call your favorite mortgage guy, Steve. You know all my contacts are in here. Go out and find me, friend me on all socials. I'm here for you, but it starts with that strategy. You guys have a great week, and bye now.
Games, and I can't take it anymore.